Every Monday to Friday, this is Peter Lewis's Money Talk.
Money Talk.
Good morning, this is Peter Lewis welcoming you to my podcast Money Talk for Wednesday the 19th of April. And this podcast is sponsored by Surfin Group, which is headquartered in Singapore, and it offers online financial services to 30 million customers across 10 countries. In today's business and finance headlines, China's GDP grew 4.5% year-on-year in the first quarter, accelerating from 2.9% growth in Q4. That was above market estimates of 4% and the strongest pace of expansion since the first quarter of 2022. Retail sales in China rose 10.6% year-on-year in March, topping expectations of 7.4% and hinting at increased consumer confidence after 3 years of zero COVID restrictions. This was the strongest pace of growth in the retail trade since June 2021. The Reserve Bank of Australia warned that further tightening in monetary policy could come if needed. The central bank said in a statement that it was important to be clear that monetary policy may need to be tightened at subsequent meetings, and that the purpose of pausing at this meeting was to allow time to gather more information. Apple chief executive Tim Cook has launched the company's first retail store in India, in the financial capital Mumbai. Reports say that people from across India came to Mumbai to participate in the opening event. Apple will open its second outlet in the country in Delhi on Thursday. And the stores will bring Apple closer to a market with one of the youngest populations in the world and a fast-growing economy where there's increasing appetites for high-end smartphones. On today's programme, I'm joined by personal wealth advisor Enzio von Pfeil and Hong Kong-based macro strategist Patrick Bennett. With a view from Japan is Nick Smith, Japan strategist at CLSA. And if you want to get in touch, please do go and visit my website, peterlewismoneytalk.substack.com.
Peter Lewis's Money Talk.
In a quiet session on Wall Street, US stocks closed almost unchanged as analysts sifted through the latest round of corporate earnings reports for insights into how corporate America is faring against a backdrop of rising interest rates and persistent inflation. Johnson & Johnson and Bank of America produced better than expected earnings on Tuesday, while Goldman Sachs fell short on revenue estimates. The S&P 500 rose just 0.1% to 4,155. The Dow slipped 11 points, that's under 0.1% to 33,977. The Nasdaq was also flat at 12,153. After the closing bell, streaming giant Netflix posted mixed results. Earnings topped Wall Street's estimates, while revenue came in slightly below them, and the streaming service added only 1.75 million customers in the first quarter. Investors were expecting about 2.4 million new customers. In after-hours trading, shares of Netflix initially fell more than 10%, but later recovered to the flat line. Over in the mainland, the Shanghai Composite was up 0.2% at 3,393, while in Shenzhen, the tech-heavy Chinex fell 0.1%. About 40 companies listed on the mainland announced that shareholders or senior management plan to offload their stakes. In Hong Kong, the Hang Seng Index was 132 points, or 0.6% lower, at 20,651. The tech index slumped 1.2%. AI firm SenseTime fell 1.4% in Hong Kong after an exchange filing showed Alibaba recently sold 40 million shares. And Chinese sportswear giant Anta Sports raised about $1.5 billion through a top-up placement in Hong Kong on Tuesday. It's Hong Kong's largest follow-on share sale since 2021. The firm priced the shares at a discount of 8.8% to Monday's close, and shares of Anta Sports slumped over 7% in Hong Kong. Elsewhere in the markets, the US dollar sold off on Tuesday, with the dollar index down about 1/3%, pairing some of Monday's gains. And you can get more details on the latest market movements on my daily blog, which is once again peterlewismoneytalk.substack.com.
Every Monday to Friday, this is Peter Lewis's Money Talk. Peter Lewis's Money Talk.
Let's go and welcome our guests. We have on this Wednesday morning, and every Wednesday morning, wealth investment strategist Enzio von Pfeil. Morning to you, Enzio.
Good morning, Peter.
And also joining us, Patrick Bennett, who is a Hong Kong-based macro strategist. Morning to you, Patrick.
Yes, good morning, Peter.
So let's start with that wealth of data. It was a big data dump out of the mainland yesterday. Let's start with the GDP data. grew 4.5% year on year in the first quarter, that accelerating from 2.9% in the fourth quarter of last year. It was boosted by strong growth in exports and infrastructure investments and a rebound in property prices. This was above market estimates of 4%. And the strongest pace of expansion in about a year. Tertiary industry, which includes the services sector, that grew 5.4% from a year earlier, which is the fastest pace in 18 months. And this was the third straight quarterly expansion as well. On a quarterly basis, the economy grew 0.6% in the fourth quarter. That matched market forecasts. Enzio, do you want to give us a sort of an overview, first of all, of the GDP data itself? What are your thoughts? Obviously, beating expectations, but is it as strong as it looks?
No, I think that China is risking becoming a mini Japan for two reasons. First of all, there's been a contradiction, which is weak consumer spending overall, really for the past couple of years, but the consumer price index is still very low, inching along at 0.7%. So there's a risk of deflation coming into China. Mm-hmm. And secondly, we've got strong headwinds because of the demographic challenges in China, efforts to develop the digital economy, and homegrown innovation being impinged upon by the U.S.-China relationships. Those are headwinds that will impede growth going forward. So even if these numbers look a bit more like a rebound to me than an actual structural shift upwards in the growth trajectory.
You say it risks becoming like Japan. What has it got to do to avoid that decade of lost growth that Japan had?
Less job insecurity and demographics. Demographics we all know about, but it's the job insecurity through the friend shoring. In other words, multinationals going offshore, the kind of the negative utility effects of increased fiscal spending, increased monetary expansion, which is what we've seen so much in Japan, yet very little growth coming through because people are nervous about their income, so they're preferring to save also for their pensions as opposed to spending.
Patrick, what do you think? It's obviously a stronger number than most people anticipated, but is it as good as it looks?
No, look, absolutely the number beat expectations, but I think all the numbers we've seen out of China in the last 2 or 3 months are really somewhat flattered to deceive. I agree with Enzio's analysis there. I think China faces incredible headwinds this year, and forward from that. Certainly we were expecting to see some rebound from what has been 3 years of COVID-influenced activity. But the number then doesn't really stack up that well. I think there are a number of challenges or headwinds. Again, as Enzio mentioned there, I think the US-China tensions, I think, are one which will continue to play and are continuing to play very strongly. Exports, yes, they were stronger in Q1, but will certainly be challenged under the influence of tighter global monetary policy. So we're yet to see the impact of that. Domestically, we have the travails of the property sector, which simply aren't going away. So getting the consumer to be a driver of activity, which has been one of the goals and was expressed very clearly in the MPC, I think is going to be a very difficult to achieve. So from being probably Panglossian towards the Chinese economy for a number of years, I'm certainly approaching it now with a higher degree of caution.
I mean, it does seem a bit of an uneven recovery, doesn't it? Even the National Bureau of Statistics, their spokesman himself, said at the press briefing yesterday that the foundation for the rebound isn't solid. So although we had good retail sales data, when you start digging into things like industrial production, fixed assets investments, they've missed estimates. So it looks like it's going to be a bumpy ride, doesn't it?
Look, I think that's exactly right. I think it's going to be uneven, at best. The increase in or the better consumer activity in Q1 is probably not unsurprising, given how constrained the consumer has been, during the zero COVID time. So, I'm not convinced that's going to be sustained, particularly not, as I say, with the influence of the of the soft property market. The external demand, as I say, is going to be difficult. So I think bumpy, uneven, similar or the same term. So I don't think we should be getting too excited about a headline number which meet expectations.
Enzio, if we want to take a positive from sort of digging down into the GDP data, tertiary industries, that includes the services sector, that grew 5.4% from a year ago, the fastest pace in 18 months. So even if manufacturing maybe is not doing as well, it does look like the services sector is growing at quite a good clip.
It's growing at a good clip, but it's still growing more slowly than during the COVID panic of 2019. So again, we're not trying to be negative on China. All that I'm pointing out is that yes, there is a rebound in growth, but whether the rebound is sustainable, I have my doubts, because I think that there are some structural forces coming in, for instance, the demographics. The other thing is that consumption used to account for 55% of GDP. Now it accounts only for 33%. In other words, consumption is 40% less important to the Chinese economy than it used to be back in 2021, which was actually quite recently ago type thing.
The government's got a target of 5.5%, so it's still below target, isn't it? It might be better than expected, but the economy's got some work to do to try and meet that target. Do you think it can do it?
You can always finesse the numbers in any economy, whether it's China, Japan, Germany, the US. It doesn't matter, because there is a very large chunk of in GDP accounting called government consumption, and of course, if you just whack that up, then you get your magic 5.5. I think the real issue for Beijing has got to be job creation, and I think one of the key structural sclerotic factors there has to be the hukou system, whereby it's very difficult for migrants from the rural areas, that's about 900 million people, to migrate to the more urbanized clusters where the jobs are being created.
Well, let me ask you then about the unemployment rate. Maybe, Patrick, you can give your thoughts first. It's 5.3%. That's still stubbornly high, isn't it? But the real shocker in this is the youth jobless rate. Hit 19.6% in March. That's the second highest in history, very close to a record high. These are concerning numbers, aren't they?
Well, look, absolutely. And if we look on an international perspective, where we're seeing still relatively or strong employment internationally, along with inflation, and in China, yes, we get a better headline growth number, but the underlying details are concerning, and no much more so than the unemployment rate. As you say, the youth unemployment, trying to get consumption up. With unemployment being high, particularly amongst the youth who tend to have who have a higher propensity to spend rather than save, I think simply just points to this, these risks of this uneven nature of the recovery and the difficulty in achieving these goals.
Why is it that the youth rate is so high? What's going wrong, and what is it that's stopping sort of graduates getting jobs and?
Well, look, I think that one item or one area I think has been the development of tech in the last few years. We know that there's been a shutdown or a move against tech, which has recently been eased. I think youth like to work in perhaps a different environment or a different sort of mode than has been traditional. The so-called gig economy, I think, was one which has had its place in China as well. So, looking for security versus a gig economy job versus something in tech, and those things are just not so simple at the moment, either in China or indeed internationally.
Enzio, what is it that's gone wrong that's really sent the jobless rate amongst the 16 to 24-year-olds almost to a record high?
It's got to be education policy. The supply of students being ejected or being sort of created is sailing way past the demand of labor. And I think a key concern here that I have is the lacking vocation, the lacking, at least what we know of in the West, the lacking vocational training in China, if they were to just take the German plug-and-play model, the German, the Swiss, the Austrian plug-and-play model, I think millions of jobs could be created quite quickly, because people need their homes repaired, they need their roofs repaired, their autos repaired, all this kind of stuff that is a steady income. A house doesn't care if there's a recession, its roof will fall in. And I think it's very much an educational demand-supply mismatch.
Also, I suppose if you look at the sectors that Beijing cracked down on in its regulatory crackdown that went on for about 2 years, it was the education sector and e-commerce and tech, and those two sectors traditionally they're very big job generators, aren't they, for graduates and for the young people. Yeah,
but I mean, if you have, I think within education, for instance, being a little bit of an educator myself, if you have too many archaeology and English and linguistic graduates and too few accounting and law and all that kind of work graduates and too few vocational graduates in leisure, in catering, in industry, in just making, in machinery making and tool making, then I think you're going to have a problem. And I think this is a major problem in the West, which is globally, which is what I call extravagant expectations. Because I have a degree, a BA, I think I'm entitled to a better job than being a mere waiter. Well, I'm not so sure. Being a mere waiter gives you better tips and better income than being some clerk somewhere.
Okay. Patrick, let me ask you about the retail sales data. Rose 10.6% year on year in March, well above expectations there of 7.4%. Strongest growth in the retail trade since June 2021. Was boosted a lot by catering. Though, what do you make of that? Yeah,
look, boosted by catering, I think, the so-called pent-up demand, and we've seen this in other economies around the globe as they emerge from, their own COVID restrictions. So, yeah, I'm not convinced that's going to be sustained. As Enzio pointed out earlier, consumption has really reduced as a source of activity. It's a long time been a focus of international policymakers to try and get Chinese savers to open their pocketbooks. Well, we saw in the end of last year and at the start of this year through the loan data, Chinese consumers in fact paying back their mortgages because they were concerned about rather than not paying them at all, as it was the case last year. And so getting a consumer to spend has been a difficult one. The numbers this quarter in retail sales, I think, are simply nothing more than some pent-up demand, and I really struggle to see that they're going to be sustained. And also, I suppose there's a base effect here, isn't it? If you compare to March last year, Shanghai was just starting this, 2-3 month lockdown that it went through. Presumably that's part of the reason as well? Oh, look, absolutely. If we look at, savings, savings amount, savings, the balance of savings accounts, they've simply gone up and up and up. Over the last few years, as they have in other economies as well, So to see some release of that in the early stages is not surprising, but to see that continue, I think would be we do not expect to see that. Enzio, are households on the mainland still under pressure? Because if you look at urban household income, it increased by only 2.7% year on year in real terms. It tends to suggest that they are under some strain, doesn't it?
Well, and this is exactly why the deposits are rising so strongly in China. The household deposits rose by 17.8 trillion won last year, and that's a big number. But this year they've already risen, if you annualize it, by double that. So I think that it's a lot of job insecurity, and I think again because of the mismatch in education, because of the demographics. Especially it's the women who drive the finances in China. We all know that, and thank God they do. And I think that that's where the feminine caution comes in to just going and blowing it all on spending for that big shiny car. So they are under pressure, and that savings demand for savings will only increase because the global economy isn't about to take off and go through the roof either. So it's not just China; it's the global structural slowdown.
So you're blaming the housewives for not spending enough, Enzio?
Well, I'm supporting them for not. I think they're always ever the feminine is more wise.
Patrick, let me ask you about industrial production. Rose 3.9% in March. That is an acceleration from the 2.4% we saw in the first 2 months of the year, but it was below expectations. What I'm slightly bemused about here is that we hear about all this stimulus. We had record amounts of credit for the month of March going into the economy. You would have thought it would have had a bigger boost on factory outputs. Why hasn't it?
Yeah, look, I think simply that external demand is soft, notwithstanding the export numbers were somewhat better than expected. But the outlook for external demand remains soft. The outlook for capital goods purchases, which are domestic, which are purchased in China, remains soft. The outlook for property, also soft. So all the tooling and all the goods in those sectors, in the capital goods sectors, is under pressure. Yeah, look, a good point about the loan data. And the data that we have seen year to date, yes, we've seen some very high headline numbers, but the makeup of that has been very, very soft. We've seen some refinancing data in that consumer lending. We've touched on earlier has been very soft. So I think it plays again to this concept of the unevenness of the recovery, in China, and given the outlook for external demand under the influence, as I mentioned earlier, of tighter global monetary policy, then I think that this may be the better number that we get, over the next few months, which would suggest we may be at a somewhat of a high watermark already.
Do you think this data will prompt the government to stimulate more?
I think so. I believe that we will see another cut in the MLF rate. I know we didn't get that this week, but given the imbalance in the lending data, given the unevenness of the recovery data that we've just seen, I think we'll see some more. We've seen already a triple R cut. I think we'll see a cut in rates to come sometime before the end of this half.
Enzio, this lower than expected fixed asset investment doesn't really match where all this credit expansion doesn't match the record credit expansion we saw in the last quarter. So where's all the money going?
Well, it could be going to support private sector firms that are just having a tough time staying above water. That's the only way they can square that circle. But
private investment was quite weak, wasn't it? I think it was up under 1%. So it's sort of, you would think, wouldn't you, that if the economy is recovering, companies will be investing and spending, but they don't seem to be.
Well, I think there's a little bit of government policy in that. The government, as we know, wants to centralize the economic management, which is fine. It's especially for such a huge, disparate economy. I think that's okay. But the problem is that at a local and a county level, the implementation of central government directives becomes a very opaque, murky area. And I've read a few press reports that suggest that it's this implementation at the local level. I think that's problem number one. Problem number two is, of course, just that exports aren't going to be the big booster that they have been, because guess what? Thanks to our American friends, the U.S.-China trade tensions, and to the Chinese, the U.S.-China trade tensions have grown so stark that there's a lot of disincentive to invest in China. You don't know what these politicians in Capitol Hill and Beijing are actually going to, what are they up to? So I think it's a mixture of corporate insolvency and also just export sort of gloom that are driving this sort of overcapacity, underinvestment, and underproduction.
Patrick, we did see a big drop in industrial profits, didn't we? It was about 23%. It really seems that the businesses are reluctant to spend, reluctant to invest. What do you think is holding them back?
Yeah, look, I think a lack of forecast strong demand, I think, is holding back. Pricing power, is still there to some degree, although, as Enzio mentioned at the beginning of the program, that CPI is still low. So I think there's a real sense of caution amongst not just consumers, even though they may have spent some of this, this saved money, but a sense of caution amongst businesses as well. So again, the prospects look to be very challenging.
Enzio, what about the property side? Any signs of property investment recovering?
Not from my reading of the press. It just again seems as if everything, to put it simply, it's on hold. They and if it's anybody who is doing the investing, it's actually the SOE, the state-owned property developers, not the private, because of, guess what, so many of them are bankrupt. So they're not, and that's again where a lot of this credit growth probably has been going, into this abyss of defunct property companies. And so again, I think that this is a structural thing that you can't just solve with cyclical magical wands like monetary and fiscal policy. It doesn't work that easily.
Patrick, final word to you. Thoughts on what this means for the markets then, particularly Chinese equities and also the Chinese yuan?
Yeah, look, I think first on the currency, I think we look at the currency as underperforming over the next 3 to 6 months. External demand to be weak, the recovery to be uneven. So I'd be a seller of the yuan against more stable currencies in the region, the Singapore dollar or the Japanese yen. I think the yuan can depreciate against both. Yeah, equities, still sustained by, obviously there's still a lot of liquidity in the global markets, but I think it's probably back towards more defensive, the utility type counters, I think, are the ones which will outperform from here.
Okay, well, thank you both very much for your thoughts this morning. You heard there wealth investment strategist Enzio von Pfeil and also Hong Kong-based macro strategist Patrick Bennett. I'm joined now by Nick Smith, who is Japan strategist at CLSA in Tokyo. Very good morning, Nick.
Good morning to you.
Let me ask you about Warren Buffett. We've seen quite a lot of his investment strategy in the last couple of weeks or so. He seems to be selling his stakes in some major Chinese and Taiwanese companies, in particular automaker BYD. He's been reducing his stake in that. He's also been reducing his stake in Taiwan semiconductor manufacturing, mainly because of China-US tensions, he says. But he does seem to like Japan, doesn't he? What does he see in Japan?
Well, I think most people agree that Japan's absolutely dirt cheap. I think one way of looking at it is the cyclically adjusted price earnings, which is basically the Buffett as a disciple of Graham and Dodd, and it's basically a Graham and Dodd way of looking at the price compared to 10-year average earnings. And on that, the US is on 30 times and Japan's on 20, but Japan's on much lower interest rates. So he does look at things and say, look at the yield on bonds compared to the earnings yield or compared to the dividend yield, and Japanese companies pay very, very good dividends. So he must be looking at the US valuations and say they're close to the highest in history, and look at Japan. They're right at the bottom of their range, very low interest rates, with US rates where they are, with US valuations where they are. Studies suggest that the growth over the next 10 years would be close to nothing.
I mean, what stands out is that if you look at his portfolio of holdings outside of the US now, it's only Japan that is investing in. It's almost like he sees no other value elsewhere other than Japan.
Well, I think that so what he's gone for are some trading companies which generate pretty decent returns. I mean, he told you gives you a 5-year average return on equity of 16%. These trading companies have been giving you 4-5% dividend yields, and he compares that with the long bond at the moment 0.5%, and when he got in there, it was less than 0.25%. So obviously, the spread between the two of them screams you ought to be looking at this. But I think when he looks at the trading companies, he has kept saying, but they're a lot like us. Berkshire Hathaway, compared with trading companies, they're similar businesses. And so it is very attractive. He keeps saying, I want to be in your next deal with you.
But would you, I mean, if you look at what he holds, in the US. His biggest holding is Apple. He likes financials, doesn't he, and banks and insurance companies, and he likes energy companies as well, the traditional polluters he particularly likes. Should he look at the same things in Japan?
Not necessarily. So I think it's particularly interesting, his 43% of his portfolio in Apple, which is on, 45 times book. So he does keep telling us, really, I don't give a damn about book. He actually said when questioned about Japan, earnings are what determine value, not book value. In fact, if anything, we're less likely to look at something as a low relationship to book than something that trades at a high relationship to book. So it reminds you, no, not book value, no, certainly not tangible book value, but he's looking for... So if you looked at businesses, of course he likes a well-run business, he likes something with relatively low volatility, and of the trading companies, that's clearly a torture. For banks, well, banks are the cheapest sector in Japan on cyclically adjusted price earnings. So you could argue, well, no one's going to say that they're particularly well-run, attractive businesses, but on the other side, he does buy banks when they're on their flat on their backs, and of course, the Japanese banks have been suffering financial repression for a decade, and it looks as if the Bank of Japan's about to come out of that. So it's worth sniffing around them. And then people forget that another extremely cheap sector in Japan is autos. And you may not like autos, but note that he does own GM. So he might look at Japanese autos and say, well, actually, they've been oversold. They are well-run businesses.
How is their business doing in China? Because we're hearing that the Japanese automakers on the mainland are falling behind a bit in things like electric vehicles, where the domestic manufacturers and some of the Europeans are really sort of stealing a march. Is that a problem for them?
Well, obviously, people. BYD made money in electric vehicles, and Tesla makes money in electric vehicles, and the rest of them are struggling with it. So you've got to remember that the reason that Dyson didn't go into electric vehicles is because you need to make money out of other vehicles to be able to subsidize the electric vehicle business. So the Japanese are looking at their hybrids, for example, and saying, we make money elsewhere, and now's not the time for ploughing a huge amount of money into electric vehicles. You might disagree with that, but certainly there are other arguments out there.
So what does this do overall for the Japanese market, and in particular foreign investors? Do they look at what Warren Buffett is doing and saying, okay, maybe there's something in this, and we ought to be looking around as well for some of these undervalued companies with good management, with strong earnings growth, and also taking into account that he doesn't care about book value, although if you look at Japan, it's one of the cheapest markets in the world, isn't it, in terms of trading below book?
Sure, I think 53% of Topix stocks do trade below book, but they're also cheap on other measures. I mean, I think the people are coming round to the idea that corporate governance is improving, that pressure is being brought to bear by the stock exchange on companies to up their game, and that actually over the last 10 years, earnings growth has been better from Japanese companies than US or a lot of other major markets. So it's got a reputation for not growing, but corporate profits are certainly growing. I mean, I think you do use that argument that says, well, you don't turn your nose up at Nestle or other Swiss companies because you say, I don't like the Swiss economy at the moment, but people tend to say that about Japan, and of course we're talking about global businesses.
So if you were to make a recommendation to him, I'm sure he's listening, what would be your top pick? Obviously outside of the trading houses, which he already owns, where would you suggest he looks as your top recommendation?
Well, I think it's good having a sniff around the banks. They're highly correlated with and geared into a rise in interest rates, which seems on the cards. there are automakers that I would recommend. I'm not allowed in this to give you individual names, but I think there are names in automakers that are worth sniffing at. And like I say, Buffett already owns GM. So those are some of the things that I've been recommending.
And is Japan maybe insulated from some of the global problems that we're seeing? Obviously, it's not affected by the US-China tensions, certainly not directly anyway, but is it also insulated from the slowdown that we're seeing in growth in the US and elsewhere and rising interest rates?
Well, certainly Japan's got the highest GDP growth forecast of G7, or at least it's the least dirty shirt. And then even next year, it's the consensus GDP growth is faster than the US. And I think the reason is, well, Japan had late reopening, so it's starting to get the benefits of reopening now, whereas the others are starting to wheeze. So I think it will manage to keep growing through this. So I think corporate profits, the consensus is looking for 6 to 7% profit growth into March 24 year on year.
Nick, it's always a pleasure talking to you. Thank you very much indeed. That's Nick Smith, who is Japan strategist at CLSA in Tokyo. And thank you for listening this morning. On tomorrow's Money Talk, I'll be joined by Andrew Ferris, CEO of Econosis Advisory, and David Friedland, Managing Director of Asia Pacific at Interactive Brokers. And with a view from Taiwan is Ross Feingold, Business Development Director at SafePro Group. Have a great day.
Money Talk